Okay, everybody, it's Thursday, and here we are for the happy hour, the ETF Think Tank happy hour. My name is Dan Weisskopf, and I'm a portfolio manager at Title Financial Group, and also lead ETF strategist for the ETF Think Tank. And today we're going to have a great show with Jens Nordvig. But first, let's kick it off to Cynthia, and she will take it from here.
Hey, everybody. Cynthia Murphy here, head of research for the ETF Think Tank. Thanks for joining us. We have another amazing guest, so great conversation coming up. We're always really thrilled for you guys joining us and joining us in the conversation. David, you want to introduce yourself, and then we'll kick off to our guest?
Absolutely. Hello, everyone. David Chikinsky here, fellow portfolio manager within the Title Financial Group. Very excited for today's show, which is going to be a nice mix of all things macro, some AI, and just loads of data. Jens has a very interesting company called Market Reader, CEO and founder of. So Jens, if you wouldn't mind, give us a little bit of background on yourself. Tell us how you got here, a little bit about Market Reader, and we'll kick off from there.
Yes, so I spent the bulk of my career servicing, institutional investors around the world, working for Bridgewater Associates. I was head of research at Nomura Securities, and also managed some research at Goldman Sachs. So I've really been dealing with a pretty narrow niche of people, right? Because if you think about those institutional investors that, manage more than $100 billion or whatever the criteria you use, there's not that many of them, right? So I've been hanging out with, 100, 200 names around the world for most of my career. And really the idea between my new venture, Market Reader, was to do some technology that's cool and it has a kind of institutional level quality, but can be used by a lot of people, right? So what Market Reader does is that it literally gives you insight into why markets are moving in real time. And it could be an ETF, right? So if we just analyze, what's going on with the semiconductor ETF today, right? It could be some macro news that is moving it. Ideally, we capture that. But it could also be bottom up, that there's like a couple of names within the ETF that are moving, right? And we will capture that at the bottom up because we watch the entire market in real time around the clock. So you can relax a little bit and do other things. So that's the idea, to really give a massive upgrade to like a manual process where you have to figure out what's going on your own, piece it all together, right? It's supposed to do that for you. So it's been really fun to work with. And the AI dimension of that is important, right? Because it allows us to really put those insight in a piece of text that gives the gist of what's going on and just a couple of lines that you can read in 1 second. And that really wasn't possible 2 years ago when the large language models haven't really been made available to everybody.
So can I just ask real quick before we get into markets? In the ETF space, we're always, dropping our famous line about democratization of access and all that stuff, all the good stuff. And was that the motivation for you, the concept of democratizing access to institutional expertise to everybody else? Or was this really an opportunity for like tech development? You saw some white space there. I mean, what's the...
Both like that. I thought it could be really fun to do something that was for a huge audience, right? So there's about 500 million people in the world who trade in some form. Like lots of people trade stocks, especially US stocks. Lots of people trade crypto. Some people trade currencies, right? But it's about 500 million people. It's not a small number, right? So if you compare, okay, what would be fun? Would it be fun to have, 500 institutional clients or 500 million end users? I think it would be fun to do something for a big audience like that and influence how they feel about markets, get them better educated in the process. So for example, I'm not a crypto expert myself, but I have learned a lot about crypto from looking at the content in Market Reader, seeing like, okay, what's going on every day, right? So I've used it for my own education. When Silicon Valley Bank was cracking, right? Market Reader essentially taught me about what's going on with regional banks, right? Because it's parsed all the information, right? And told me, like, I can literally remember that Wednesday night when the bad news came out, it told me, okay, Silicon Valley Bank is the epicenter of this whole move, and First Republic Bank is next in line. Like they were literally there, 1 and 2, right? And I had never had those two names on a Bloomberg screen, right? But that this system finds where the epicenter is, especially when there's something dramatic going on. So it can educate people even if they're starting from a pretty high level.
So how do you train a system to know what kind of outputs you're looking for in that? Like how does that work on the back end? Because I would imagine there's a lot of noise that you need to filter out with this, right? A lot of this is like getting the right data set and then also like filtering out the bad and promoting the good. And how do you organically do that?
Yeah, so I think Market Reader is very much about getting rid of the noise. Like there's so much noise out there. If you think about social media, if you want to use social media for anything, like you'll have to get rid of more than 99% of the content. So our approach has been like, in order to analyze markets, understand market moves, you need to have like a multi-dimensional approach, right? So there's four main dimensions in the system, like something to do with news, something to do with flow, something to do with events, something to do with cross-asset moves. Like those are the 4 big dimensions, and we can talk about this for a couple of weeks, like all the sub-dimensions, but let's just stick to those 4. And if you cover those 4 well, you can explain markets really well, and that's what we've been cranking, right? But it's not about finding news on the internet. It's about having loads of models that cover all those different dimensions, and obviously we ingest some news, right? But it ends up being a pretty small part of the picture. So there's a lot of quant analysis that gives content. Like, for example, right, we have a lot of situations where there's one company that reports, and it moves other names with it, right? So Market Reader is very good at saying, okay, Delta Airlines reported. It's actually moving, American Air and United with it. That happened this week, right? And it will write a story by that, not because it found it somewhere else and managed to say, put the pieces together, but it's actually write that story itself within the system, right? So that's the power of AI, that we can get this text generated automatically that we really couldn't in the same way a couple of years ago.
So when I look at ETFs, and then, people got into the ETF industry for different reasons. For me, it wasn't because of the fee as an investor that would be compelling for a lot of people. It was a bit about the tax efficiency, I admit that, but mostly it was about the transparency and the knowledge that you glean from what's happening within the context of certain ETFs. When I look at, like, as an example, we're talking about AI, there's 2 ETFs that I often think about, which is bots and Robo, right? Robo is very diversified and bots is very concentrated, right? With like consistently NVIDIA being the dominant holding in that. How does it work, your system, when you've got 2 different ETFs and the information flow coming out? Is it about the robotics, or it's about the companies that within the context that's moving those markets, I would say?
It can be both, right? So we don't want to have a simple process that works once in a while. We want to have a nuanced process, right, that is able to capture all the differences, right? So this week, right, we've had the inflation news, 2 installments of it, right? CPI first, PPI next, right? And they both moved the markets, and they would have moved both those 2 ETFs that you were talking about because the whole market moving, right? So in that situation, we want to write a story where we say, okay, bots and the other related ETFs are down because of CPI, right? And then they were up a bit because of PPI, and that will indeed be the content you see in there, especially if you analyze it in the high-frequency space, right? But it would also tell you that, okay, there's specific activity in specific names if that activity is meaningful enough to drive the ETF, right? So we can discuss, should it be 10% of the performance or whatever it is, right? But we've set certain thresholds where the micro becomes important if it goes above a certain limit, and the macro is important if that goes above a certain limit.
I guess what I think is like the hardest feat that you guys have done a great job with is overcoming relevancy of a certain macro indicator in certain times and less relevant in other times, right?
Yeah.
So if you could speak on that, like all of a sudden.
Happy to talk about that. That's actually something we had to change a little bit over the last couple of months, because we're in this funky cycle. We're in a funky macro cycle, right, where it actually has changed quite quickly, which indicators are relevant. And
everything matters to rates now, right? Everything is rate dependent, and now the Mag 7 is moving like positively correlated with treasury rates versus like everything else. So yeah, if you could speak to that, like how do you change those important times?
Yes, but we can use today as a perfect example. It makes it easier, right? We remember before the COVID shock, and even into the first part of the COVID shock, nobody cared about PPI ever. PPI was a totally irrelevant indicator. I used to sit on the prop desk at Goldman, right? And one of my jobs was I had to shout out to everybody in the trading desk whether the numbers were good and bad. But there was nobody ever shouting about PPI because nobody cared about it, right? People cared about payrolls. They cared about other data releases. But that's changed, right? So in terms of how we design the system, how do we statistically, measure whether a given release is important or not? Like in statistical terms, we can't look too far back in the past, right? Because that will essentially capture like when we were in a different regime. So we have to be pretty pragmatic and use windows that are not too long when we statistically determine whether certain things can be important, right? So PPI has become very relevant, I would say, over the last year. So that should be the look-back period that we use, and that's why it's shown correctly in the system now. If we'd used a 5-year period, the system would have been in trouble today.
So when we were looking at the system, you and I think, had a brief dialogue about gold, right? What's the system telling us now about gold? Because it's finally in favor, right?
Yeah. Well, so I think gold is a very tricky one, right? Because our system is designed to capture, are assets moving in a logical way relative to how they've logically moved? Is there any news coming out that is driving it, right? And gold is a bit of a special case here, right? Because the correlations are totally breaking, right? And do we have a lot of news every day that's driving gold? Not really. So this is a very tricky one, right? Because we're trying to capture new information in the system, right? So it's almost like the ideal story you want to write there is a story. And when I say you want to write, I mean algorithmically in an artificial intelligence sense. I mean it would be a story where you say, okay, the dollar has been strong this week. Gold is up nevertheless, right? Interest rates are up this week. Gold is up nevertheless. It's kind of like you want, ideally have the AI use the word despite a number of times. Like it's checking different things and say, okay, despite these things actually going against gold, it's still up, right? That's the story you want to write. And then obviously you can try to search for the explanation, right? But I don't think that's an explanation that is about short-term price action. I think gold is a bit special, like we've now had a 2-month trend that is a historical move that has not happened before. And everybody's kind of scratching their head like, what the heck is going on? And different people have different explanations. And like one thing I find pretty amazing about this gold move is that even if you look about the flow, a lot of the flow you have to use the word despite. Gold is up despite ETF selling. Gold is up over the last 3 weeks despite no additional spec buying on COMEX. It's a pretty remarkable situation, right? You can tick all the usual boxes, right? And there's like 4 of them are ticked down where you say, okay, it's not that, it's not that, it's not that, it's not that.
So the thesis is it's the central banks, right? Like the flows were negatives in the ETFs, but people think it's like the central banks. So like, how do you pick that up then?
Yeah, I don't think so. We have to be honest, right? What can we do, and what is outside the limits, right? If there's secret central bank buying, it's going to be hard to find any data to use for that in the system, right? So I think the best use of the system there is that you get pointed out, okay, it's not the usual things. That, I think, is the best the system can do with this special case. And I agree with you. Like, if I take a step back and think about what's happened this year, right? The big thing that I can see when I analyze it as a human, trying to think the best I can, right, is that the demand out of China looks like it's doing something we've never seen before, right? And we can't see in real time what the central bank is doing. We also don't know whether they are recording their central bank activity in a fair, correct way. We don't know. Chinese statistics are unreliable. But the good thing about the trade statistics is that those you can cross-reference. Like the importing of gold that they do in China, we can typically find like where is the export coming from, right? So we can cross-check the Chinese data in that way. So I think the bottom line for me is that the stuff that has really changed this year is the amount of gold that China is importing. And we don't have the data for March yet. That will come next week. That will be important confirmation whether that's still what's going on. But I'll give you one stat that's interesting. And that is, excuse me, if you break down the price action in gold right now and look at what's happening in the London time zone, New York time zone, Asian time zone, a lot of the latest move is in the Asian time zone. So that gives you a clue at least.
Okay. And does I wrote an article recently on the miners. Does the system do a comparison between what's happening with gold and the equities? And does it distinguish between which ETF might be the best way?
Yeah, so before you gave like a very difficult example, okay, analyze an asset that's doing something it's never really done before. That's kind of like the most difficult example. But if you think about gold miners, that's in the other end. Like that's pretty easy, right? Gold miners is moving extremely correlated with the gold price, right? And that's happening every day. And we can see that and we can monitor that. So GDX, I think, is the main one, like a lot of people know about. Yeah, like one thing that I think I might have shown you before, like we can also use the system to essentially give you the report. What happened over the last month, right? And then it'll summarize everything that was important over the last month, right? So that's another use case. Like one use case is, okay, stay on top of what's going on, right? Another thing is to say, okay, here's something I haven't really followed day and night over the last month, given a synopsis of what was the most important stuff, right? So if you can very quickly get that, it can save you a lot of time.
I love that, actually. And it's maybe replacing somebody's job or just making somebody's job better. Sorry, Cynthia, go ahead.
No, I was just going to ask, I've read before, an article about AI doing analysis and the possibility of it establishing connections, whether it's correlation or causation, that we may not even have ever thought about. So I'm just wondering, like, have you encountered any surprising kind of, to the concept of writing the despite articles? Have you found any kind of, gold is up because, I don't know, Janet Yellen is wearing blue shoes, and every time she's wearing blue shoes, gold does something unexpected. I mean, have you found any kind of surprising type of AI discoveries that we would never connect those dots?
That will be the next version of the product where we add the shoe data. We haven't added the shoe data in yet, but we haven't had that suggestion before, so that's new. But a little bit more seriously, so we look at how markets are associated with each other in a very comprehensive way, right? So if you think about, we might have like roughly 10,000 assets in the system, like rounding. So 10,000 assets that are linked to 10,000 assets is like a big matrix of associations, right? So once in a while, there's definitely associations popping up where you're saying, okay, that's a little bit funky, right? And you might not have thought about that, and some of it might seem counterintuitive. So I think we need to be humble here as well. Like this is a technology that's going to deal with information in a slightly different way and on a scale that we've not really been able to do before, right? So it's going to surface content. So I continue to think that you have to combine this with human judgment. Like, is that correlation you have found Is it something that's interesting and you want to investigate and get conviction in? Or is it something where you say, okay, it was fluky, maybe they had earnings the same day for on a couple of quarters, right, and that generated, like, there can definitely be correlations that are not the same as causation, right? So, like, we have a whole part of the system that we call a causality filter, right? Like, so when there's two things that are moving, we have like a whole checklist to figure out whether the causality is going from A to B or B to A, right? So we definitely try to be careful with that. But it's hard. Markets are complicated, right? It's not like physics where I'm going to go and prove what is the truth, right? Sometimes there'll be a big debate and you can have one senior PM will disagree with another senior PM about what's going on, right? So there's room for some kind of interpretation always.
And then the other part of that argument is lunch passes and the whole argument is flipped, like we saw yesterday, right? So oftentimes we see this like two-sided market in the morning and the afternoon, and those are my favorite times to check like all the news websites, because they'll literally just like cross off one word in the title, be like, markets are up on inflation news, right? So like, how do you guys deal with that, right? Because there's so much irrationality intraday. Like, what do you, because it almost feels like these stories like literally get written the opposite way 4 hours later. So how do you handle that? Like, and so my understanding is, sorry, I apologize. A lot of the NLP stuff is really good at taking factual things from the past, driving information on it, and then providing value for it. Some of the negatives from a quantitative investment perspective has been the noise is tough, which you talked about earlier, of like taking out that noise. So what I've understood is that like these models, or at least the off-shelf ones, understanding the difference in oil being 150 and zero, and futures being zero over like a 3-year period, makes it really difficult. So how do you guys deal with that, like intraday noise?
Yeah.
Sorry.
The basic building block of the system we have set up is a 10-minute building block. Like, so everything gets reanalyzed every 10 minutes. And the reason why we have chosen that building block as humans is that we think the 10-minute increment is, number one, pretty timely, but number two, also allowing sufficient amount of information to be accumulated that you can actually draw fundamental conclusions. So our system gets fully updated every 10 minutes, right? So if the facts have changed, the analysis will change as well, right? So we don't have, it's not like a certain journalist that puts something out in the morning, right? And then it's a bit embarrassing if they have to change it. Like, the system is not embarrassed. It just deals with the fact as it gets them, right? And it will get rewritten if the facts have changed. So we try to be objective all the time, right? And the challenge will be more to do with, okay, the news element, where we draw on news that is external to the system. What if that is stale? That's the problem we're dealing with. Like, if it's the stuff that is generated inside the system, is always going to be fully up to date, right? So I think actually that issue of dealing with stale content that you are ingesting from outside, that actually, I'll be totally honest, that is one of the challenges. And we had with the development team some examples today where, like, even for gold, right, we've had, a big uptrend, and a lot of the commenting that exists on social media news is talking about the uptrend, right? And then you have wiggles around it. And do you want to, if you're trying to write about the wiggle, right, you have to be careful about how to deal with that background news. So definitely a challenge, but the system can definitely be extremely objective about all the quant that is generated at a high frequency, and that's the advantage.
Yesterday, you could almost see the market realize, oh my gosh, inflation is up consistently 3 months in a row. Oh my gosh, that must mean productivity is up as well. I guess we're going to drive these chips higher in this high interest rate environment. That's almost what it felt like. Just the market kind of slowly coming to that realization over the last 2 days. Just a random comment. Sorry, Dan. Why don't you take it?
So we've gone through a long period of time where China has been an area where people weren't investing in. But of late, as I understand it, something like $45 billion has been invested in the China ETFs by the central bank. And, Japan did this and eventually worked out wonderfully. forgetting the political aspect of China, what is the system telling you now about, China, and would flows from a central bank skew that outlook?
Yeah. So, like China is a bit of a special situation because if the president decides that he doesn't want the stock market to go down, then they find some official sector balance sheet to buy some stocks, right? So it's a while ago since we've had any official buying of stocks in the U.S. We had a thing called TOP back in 2009 that was extremely controversial, right? And we actually have legislation in place that bans that kind of thing in the U.S. now, right? So China's special. So I always have to be careful about like the things you think are logical and set in stone in the United States or other places. They don't operate in the same way in China. So I think you're right that they have been buying Chinese stocks, and we have put a little bit of bottom into the market. But I think the other thing that's going on in the global economy is that last year we had this remarkable period where growth was being revised better and better in the United States. You remember the 5% of GDP summer quarter, right? And some of that was the AI investments that drove more investments than expected. But what was particularly interesting was that it happened while Europe was being downgraded and China was being downgraded. So I think one thing that has changed this year is that actually global growth is looking a little bit more stable. I'm not saying we have a global boom, right? But we've gone through this period where like there's negative surprises every month. And that also probably helps some stock markets. And I think this week, I think I tweeted out on my own handle, which is Jens Nordvig, I tweeted out that we actually had some interesting EM outperformance early in the week, right? So EM has kind of been a forgotten asset class for a while. Like it's not only China that people stop buying, it's also other EMs, right? But people have been so focused on semiconductors and QQQ and whatever. But EM started to perform a bit better Monday, Tuesday, before the CPI at least. And that was pretty interesting to see, both in EMLC and some of the equity EM ETFs. And I think that has to do with this growth pessimism is kind of being pushed back. And I guess you can see it in commodities a little bit as well. Like the copper is breaking out. It's not just gold that's breaking out. Crude is breaking out. It's always hard to know whether it's supply and demand in commodity space that's driving it. But there's a fair few things going on that suggest the demand is not quite as bad as it was last year.
Yeah, I think the EM tech story, just the multiples are so cheap, and they are just as capable of adding tech or AI productivity gains to their ecosystem. So I definitely agree with that trade. So on the economic front,
can I add one thing on that? Like it's kind of interesting, right? So we're speaking to lots of different financial institutions around the world, right? Because we can deliver the market reader content, not just to the end user that use our platform, but we can also deliver all the data, and it can be shown on different trading platforms. Like, so obviously, like everybody knows about Robinhood in the United States, right? But there are many of them, right? But I think what's interesting about EM is that you often have more kind of monopoly power in EM countries, right? So some of these tech names that are doing well in some of these EM countries actually have more space to operate in without competition. Like, so if you think about it from that perspective, there's probably some of these EM fintech plays that are actually better than the US ones, right? Because they just have less competition in their market. So just a side comment.
And they skipped a lot of traditional banking, straight to banking on their phone, right? So like a huge portion of them only bank on their phone. And I haven't ever actually stepped into a retail bank before. So on the economic front, obviously, one of the things I loved about your presentation was almost like divvying up days into periods based on important news, whether it's on the result of a company, or the result of a competitor, announcement on oil, or some sort of macro event. But how do you take into account the revisions? Because all of a sudden, It gets a whole lot more complex when, in reality, whenever we see these turns in the markets, GDPs revised 5-6 quarters in the past. A lot of these numbers are just magically rewritten, and then it makes a lot of sense when Q4 2007 is negative GDP 6 quarters later, right? So,
Yeah.
you guys, like, because this, it just becomes like levels of difficulty once you start adding in revisions and things of that sort. So how do you guys think about that?
Yeah, so it's almost like a philosophical thing how you deal with this, right? So we subscribe to the philosophy that we want to capture the new information, right? So I'll give you one example. A couple of months ago, there was a press release on Twitter that pertained to Walmart that moved the Walmart stock, and it turned out that it was a fake press release, right? So the information was wrong, but it did move the market. So how do we want to capture that? So our philosophy is that we want to capture information that's market moving and report that information as it happens. So on that day, we reported, okay, there's somebody reporting on Twitter that there's this issue at Walmart and it moved the stock. And then a couple of hours later, right, the investor relations denied it and the stock moved back. And ideally in the system, we want to report both. I think actually the stock ended up like where it came from. It didn't move in the end, right? So that's our philosophy to that. We want to capture new information as it happens. And like if it's social media chatter stuff, like ideally we just want to convey it as such. There's people talking about this on Twitter. It could be moving the price, right? But I think this is the power of the AI, that we also can kind of cover more of a spectrum. Okay, we're very confident this is moving the price. This is something that could be, like, it doesn't have to be a binary thing where you say, okay, either or, this is relevant or not relevant. Sometimes it's in between. And ideally, we can convey something that has that nuance in the content.
Yeah, I'll just jump in here real quick, David, and go. What I love about that is the idea of, a lie is also a fact. Somebody lied on social media, and that impacted prices. So you cover it because it also happened. So I love that idea. I just wanted to make that comment of that's the whole point of real-time news, right? It has to be real-time, and news may be good, bad, fabricated, legit, but it's news and it's moving markets. So it's
and just to be clear, like we're not giving like financial advice based on something that happens on social media. We use it as context. We use it maybe to explain what's happened, right? So, but our system is not about giving financial advice, buy, sell, that kind of thing. It's high quality insights as to what's happening, but we're stopping short of giving advice. You are in a business where you have to be careful about these types of things from a compliance perspective, right? And that's also important. And certainly if financial advisors are using this type of tool, we have to have that line pretty clear.
So I guess I'll go, David. So along those lines, inflation is everybody's buzzword these days. Your system obviously is aggregating and connecting all the dots around the direction of inflation these days. Is your system saying that inflation, for better or for worse, is going to be there for longer than people expect, or does the Fed have inflation under control according to your system?
So what can the system
do? It's only a tough question.
The system can tell you, right, that we have essentially everything in the market being hypersensitive to everything to do with inflation. It moves on CPI, it moves on PPI, that used to be totally irrelevant, right? So those are examples of those things, and the stats in the system will reflect that, and it's going to be guiding how we write the AI summaries, right? Is the system going to tell you what CPI is going to be in a year from now? No. So that's bad news. It'd be nice to have a system that does that. It's also good news. It means that some of the people who might forecast inflation still have a job to do, right? So if I'm going to tell you my human view, not the AI system's views, it will
bring it on.
Yeah. we've been through a couple of months, right, where there's some fairly funky things going on with reported consumer prices, right? And if you look around the world about how inflation has behaved over the last couple of years after this crisis shock, there tends to be funky stuff going on in January and February and maybe in March. And some of that has to do with certain prices get reset in early in the year. I remember in the January number, like one of the things that went up a lot was nursing homes. So I don't think the price of nursing homes get adjusted every day. Like the invoice there probably gets adjusted once a year, right? And it used to not get adjusted at all when we had like 2% inflation. It wasn't necessary to adjust it at all, right? But now it is, because we're catching up with the past inflation. So to summarize, that basic view is like we have extra noise in the numbers early in the year after a high inflation episode where people need to do those catch-ups. It's the same we're seeing with those car insurance numbers that drove the numbers this month, right? That car insurance is catching up with all the other price increases, inflationary effects we've had over the last couple of years. And that's impacting numbers. If I'm going to give you some good news, it is that some of the medium-term drivers of inflation, such as wage growth, is not as high as it was a year ago or 2 years ago, right? So it looks like the labor market is getting more balanced. Wage growth is coming down. And that should mean that over time, the inflationary pressure is lower, even in the domestically produced stuff. And then we can go back to China, right? China just reported CPI overnight, and we essentially have, again, a deflationary situation in China, right? China has a big problem with domestic demand. Part of the reason why we have all these Chinese electric vehicles flooding the global market is that they are producing as much as they can, right? And domestic demand is not that strong, so they have to sell them internationally. That's going to put downward pressure on those types of goods. And you can see it. If you split the CPI basket into services and goods, we literally have zero inflation for goods. Zero. For many, many, many months now. It's almost a whole year where goods inflation is literally zero. And it's only the services that hold it up. And then I can quote Christine Lagarde from the European Central Bank, who spoke today. And she obviously looks at the numbers the same way as I just described, because she said, yeah, we don't need services prices to go to 2% to be okay, that we're hitting the target, right? Because there are other parts of the basket that are below 2. So effectively, like you can have, if you have, assume it's 50-50 goods and services, I'm just for an example, right? Then you're okay with 0% for goods and 4% for services. It sounds kind of a little bit counterintuitive, but that's how the basket is constructed. And I think that's the other hopeful thing, that actually the good stuff is looking way better than it did 2 years ago. And that has not changed over the last couple of months. It's some of the other more funky things that have moved around.
Yeah, the goods have been flat. Like oil has been climbing for reasons outside of traditional factors, such as just like increased demand. So that in theory could persist. And I do agree, it's a lot of the high numbers and numbers that are tied specifically to interest rates, right? Like, what are your payments on your car, right? Of course, that's going to catch up when we've had this like long period of rising interest rates. And I do think that there's going to be this yin and yang kind of flow of inflation, because when you turn off and then ramp back up,
you could get it to yeah. Does the Fed have to hike interest rates because inflation was high because interest rates were high? That's right. A little bizarre, right? So there's actually some countries where the central bank targets inflation on a metric where they try to take everything out that has to do with interest rates.
Yeah.
Right. So it's something that is quite relevant to policy. We've not really had much debate about that. Part of the reason why we haven't that much debate about that is that we've had so little inflation for 20 years that we forgot about all these quirks.
And it's come from traditionally the corporate side and not the government side of spending. And that's the other thing that people say is the difference. Like, where is the deficit coming from? And how effective is interest rates at like tamping down like a overheated business market? If they're not overheated and overspending and overinvesting, then the rates aren't really going to affect them. the number that seems to be the biggest controversy right now is in employment, and specifically type of employment, right? I see three camps right now. There's, wow, employment numbers are great, but like full-time employment is flatlined, part-time employment is rising. And then within that, there's two camps. That's the benefit of a strong society. People are choosing partial retirement and choosing to spend their times otherwise. And then the other side of it is everyone's becoming an Uber driver because they have no other options, right? And then the third camp is, I don't care, it just depends on what the overall wages are across the board of both, because it's the aggregate spending that matters. So how do you think about that? Because these are the three camps that, like, it seems like this is going to be the differentiator between how strong this economy is in the next 3 months. Is part-time labor growth to this extent a positive or a negative?
Yeah. So that you're touching on a lot of big topics there. So I wonder how many hours we got left of this. So I'm going to try to keep it relatively short. But I think one of the things that's really important is that there's more than one economy. There's more than one economy in the sense that we have some consumers that feel pretty safe in their jobs. They own a lot of stocks. They become wealthier. They might own their house. They become wealthier because of that. They have maybe a very low interest rate mortgage still, right? So they have not really suffered on the mortgage payment, right? So there's a group of consumers that are in very good shape, very good balance sheets. They're not suffered from the interest rates being high. They might even have like a money market fund that's giving them a nice coupon now. So they might have better interest rate income than they used to be, right? And then there's a group of consumers that did pretty well for, 2001, 2002, because we had big government transfers and so forth. Everybody talked about excess savings, and there was some of that. It's running out. That group of people doesn't have a lot of equity exposure. They rent instead of having a house, right? Ownership. So I think what you're starting to see is that there's a really big split in the economy between those two groups. And I think you will start to see that as more and more mortgages reset, as the credit card debt continues to roll into high interest rates and there's more of it, I think the sort of negative aspect of high interest rates that people are starting to give up on. They're saying, okay, it's not a big deal that interest rates are 5.5. We can have 5.5 forever, which is effectively what's going on in the yield curve right now. It's down to be totally flat around 5 again, right? I think we just have to realize that the lags are really long between raising interest rates and different parts of the economy really feeling it, especially because, the Fed did QE and so forth that were meant to make the pain of these things actually last longer, right? So I think it's going to take a while before we've seen the full effects, but it doesn't mean there's not going to be an effect. It just takes a long time to feed through. And I think there's a lot of credit indicators that are showing that these interest rates absolutely matter. Like, there's almost no bank credit growth in the United States. So, it's not that the banks are just lending like normal. It's just that there's been other things going on in the economy that we can manage to deliver some growth without any lending growth. But over time will be important. And obviously now we've had another leg higher in interest rates again. So I think it's going to slow down the economy over time. And then the question is how the Fed is going to respond to that, obviously.
Isn't that kind of the same story that people are saying, like, there's been this quality cleanup of HRG and J&K, and that basically, like, all of the companies that really couldn't handle those rates are now in private markets and all these private pool of capital. So there is, like, almost this unseen increased quality of, like, CCC rated debt that just magically happened by the ability of, like, who got to actually roll over their debt in this environment and get higher weightings in the index. And then the guys who couldn't are in the floating rate market in private credit because they just couldn't handle this rate. What are your thoughts on some of that and, like, some of the metrics that people are, like, waiting to see, like, credit spreads blow out, but, like, the quality might have, like, almost, like, organically increased within the credit buckets?
Yeah, like, I have to say, this just is an incredible cycle, right? Like, you ask almost anybody in 2020 or 2021, okay, how high is the Fed going to hike interest rates in this cycle? And they would have said 2, 3, right? And now we're the 5.5, right? And we still have a debate about the debate is now, are they going to be able to cut this year, right? So we've certainly seen a remarkable resilience and ability to handle much, much higher interest rates. And I think the United States is benefiting from AI investment more so than almost any other economy. So there's an AI aspect of this that's very positive. We do have immigration that supported the labor market and supported growth that is starting to be talked about more, that has been relevant. And then, financial conditions, it's complicated, right? Just because interest rates are going up, it doesn't map into financial conditions in an easy way. Like, think about what's going on in the 30-year bond. Like, the 30-year bond last year moved from 4% to 5%, and the equity market, like, melted down, right, in that summer period, right? Now we've had almost the same, from 4% to not quite 5%, but getting close, right? And the equity market thinks it's totally fine, right? So markets are complicated, right? And financial conditions are not moving in a dramatic way, right? So I'm saying I don't think the economy is not responding to interest rates at all. Eventually respond, right? But I'm not saying there's some kind of like dramatic thing going on just around the corner. This looks like it's going to take some time. Absolutely.
Yes, because when people are looking at your service models and what you're providing, who's the client, right? Who are you trying to sell to? Because it's marvelous to think about how your background is at More Capital in Bridgewater, et cetera. I mean, to have a kind of tool that somebody like that might use is quite exciting. But who is your client now?
So,
or target market, whichever you want.
So there's two types of clients, right? You can have a trading platform that can say, we want to buy the feed so we can deliver better service to our clients on the platform. That's one business, right? And in terms of end users, I would say anybody who's in the financial advisor space and has active clients can save an incredible amount of time by using this tool, right? Because they can always be on top of what's moving. If a client has a question, they can just plug it in, right, and say, okay, why is that moving? And you can also use this longer form content, right, to say, okay, what were the big moves over the month, and get summaries. So I think it can save a lot of time for financial advisors that need to deliver better client service. So that's an obvious one.
And it's a subscription model. Is that?
Yeah. So you can go to marketreader.com and you can get a trial of the product, right? Get comfortable with what it is. And then you can obviously do an individual subscription if you want to do something for a little financial advisor group, something that's beyond one person. Then you just reach out to us and we find an offer you can't refuse for you.
Well, I was going to team you out. Like, what's the price point on all of this?
Yeah, so this is frankly something we're trying to figure out, right? But we have an individual user price point, whereas like $99 a month, where we're saying, okay, do you want to do that, right? But if it's if you reach out to me and say, okay, I have a group with 25 financial advisors, what can we do? Then we'll find an attractive solution for everybody together.
Well, we'll be looking.
Yes.
Jens, I was gonna say we're 50 minutes in or so. We should start wrapping up. I think one of the things that's really cool about this whole thing, outside of markets and macro conversation, I think is just we've all been so excited watching the whole artificial intelligence, development, and it's really cool to start seeing actual applications and what that means. So in this case, an information analytical tool. It's very exciting to be seeing it happen real time. So congrats on that. I was going to ask though, you're watching global markets, updating stuff 10 minutes apart. It sounds like you don't have any free time. Is that a good thing? Do you like being this busy, or are you an expert at spending your free time?
Good question, right? So the end goal is that Market Reader is going to do all the work, right? So it analyzes everything, so I can just sit on the couch and have a nice cocktail or whatever I want to do, right? But we're not quite there yet. So it has been a lot of hard work. So we definitely welcome feedback. We wanna get people to use this technology. It's a new technology, right? And give us feedback on how it should be improved. So please check it out. It's on marketreader.com, right? And we'll love to get your feedback, good and bad, so we can make the tool better every week.
Yeah, no, if you create this AI that takes care of everything, let's franchise it. We're all in. We will wrap it here. Thanks so much for joining us and telling your story. Good luck with the product, Market Reader, and thanks everybody for joining us today. And we'll see you all next week.
Thank you so much. I'll bring a proper cocktail next time.
Bye.